think we're all here.
There's a reason why I'm an advisor and not in information technology. Sorry, folks. I know I'm a little late here getting started, but I do apologize for the technical difficulties. Somehow I knew that that was going to happen. It always seems that it does, right? The worst times there. So, um, Sam, do you want to kick us off?
Yes. Awesome. So again, thank you everyone for being here today. It's going to be a great session. Tommy is going to go over some fantastic ways to help prepare yourself as a business owner for these exit planning strategies. Um, Tommy is going to go over all this information today. He's a certified financial planner, CFP. He's also a CPA and a certified exit planning advisor. He's been in the business for about 16 years, helping other business owners strategically exit their practices and help build a great financial strategy for those exciting and important times in their lives. Um, Not just from a financial standpoint, tax standpoint, but also personal and legacy perspective. He's going to walk through what it really means to be prepared, what mistakes to avoid, and how to maximize your peace of mind as you approach those exit timelines on your own terms. And with that, Tommy, do you want to take it away?
Thank you, Sam. Appreciate that introduction. And before we get started, just want to say thank you to our sponsor, Franklin Templeton. They've been great partners of ours. As you know, Sam and I in Lighthouse Wealth Group are 100% independent, but we always appreciate sponsorships to help us do things like this and really educate a lot of folks. So thank you. Thank you, Sam, for the introduction. But like Sam mentioned, I'm a CFP, CPA, and certified exit planning advisor. Been working with business owners for over 16 years now. It's been a joy. I love it. I love entrepreneurship. I think it's great. It's what has built this country. Um, but really, how I got into this and why I got into this is before my dad retired, he was a CFO for a regional copier company in North Carolina. And I remember him telling me the story. He had just started working with a third generation business owner. It was a family member. And so, um, but he basically came into this business. And so the business owner was showing him around and said, we just bought this new business and we have all this great equipment that we got from him. And, it was really nice. And he was kind of proud of that and said, this is worth a lot of money. And I think he even gave him a number, and my dad, not to be too curt, was like, This is not as much as you think it is. It's not worth because it's depreciating. Technology is changing these things constantly." And so from that point on, I think the owner said, "Okay, well, you're going to help me value businesses and you're going to help me buy them." And so from that point on, that's how my dad got into it. So he's since retired. But that always kind of stuck with me, is this, how do you value a business? What does that look like? What does it take? And it's been always been intriguing to me. And then in 2018, maybe 17 or 18, I got involved in exit planning, the Exit Planning Institute. And they really opened my eyes as far as succession planning and exiting out, business owners exiting out of their business, and how does that work, and why. And they really were able to see how important this is, especially as the baby boomer generation was retiring. And so you had all these businesses, smaller businesses, and they didn't know really how to get out of their business, value it correctly. And so they put a program together where advisors, wealth advisors, attorneys, CPAs, could go through their program and have a better understanding of how to advise their clients on owners looking to exit and sell the practice. And so went through that program 2018, really saw the importance of this. And so my message has ever since then has been really to to help business owners understand the process and what it takes. Essentially, owners, if you've started a business or you're running a business, you know how much blood, sweat, and tears you put into this. And so my goal is always to make sure to help folks make sure they get the most value when that time comes to no longer run a company or business. So that's kind of my short version of everything. But thank you all again for attending. And yeah, just kind of jump into it. Today I'm just going to help um, business owners understand the critical steps involved in planning their exit. And so we'll be talking a lot about processes today, what that entails, and kind of educate you along the way. So this is really fascinating, but we talked about the importance of exit planning. So 80% of business owners have no exit plan, and only 20 to 30% of businesses listed for sale actually sell. So, why is that? And if you're a small, medium business owner, it's really it has been difficult to really know what value you have in your practice or your business. And so, finally, the industry is recognizing and seeing that there has to be more education related to this, um, because as you can see, only 89 or 80 to 90% of business owners, they have their net worth tied to their companies and their businesses. So making a well-planned exit crucial for financial security. So we want to make sure that because so much is tied up in the business, that we've got to make sure that we're maximizing this in a way that you can get the most when you decide to walk away, whatever that looks like. So to get kind of give you an understanding, I remember meeting with some folks years ago, and he was an entrepreneur, built his own business, and they lived very frugally. They did a good job of saving, but they recognized when they came to me, they give me their net worth, and so the number on their net worth was a really large number, and they've done a really good job on that. So looking at that and talking to them a little bit about that and just getting to know them, it was I was looking at net worth statement. I was like, hey, you guys, you have a very healthy net worth statement. And the spouse said, well, that's great, but we don't feel like that at all. We're not out there. We see what number we potentially worth with our business, but we're living like everybody else. So help us understand, how we take something like this and take the risk off the table and liquidate it, into something where they can start seeing the fruits of all of that hard work they did. And so the way I explained it to them, I said, it's very similar to our business where if you have, stock in a single company, that represents a lot of risk. There's no diversification in there. And so you're really taking all of this maybe extra money at the end of the month that you may have and putting it into the business, which is typically what entrepreneurs do. And so you've been feeding this thing, and really at the end of the day, you're getting closer to a point where you want to enjoy this, and you're having, you basically own a single stock, and that is your company. And you can kind of see the wheels turning and then to realize, okay, this makes sense now. This is a lot to have wrapped up in one asset. Great asset, great company, did an awesome job, but they just realized the importance that although it looked great on paper, they couldn't do anything with that. They didn't live the way they wanted to. And so we want to make sure that the business owner exits in a way where they can really see those fruits of all the blood, sweat, and tears they put into it. So shockingly, 75% of business owners profoundly regret selling their business within a year of exiting, often due to inadequate planning. So obviously, we're going to talk about that a little bit later, but you can see that planning, if there wasn't time and effort built in the planning side of these things, you could see that, 75% of the time, or three out of every four business owners, they really regret that. And so that is what we're going to talk about a lot today of, hey, how do we make sure we help owners exit and reducing that statistic as much as possible. And then you'll see here, a significant portion of US businesses are going to be owned by baby boomers. So, which represent about 51% of the business market set to transition in the next decade. So really exciting, really good, but just we want to make sure it's done and not just done, but done well at the same time. So, in order to understand the exit planning process, really there's three legs of a successful exit. Three things that have to come together to really have a successful exit. One is business readiness, two is owner readiness, and three, of course, is market timing. So, business readiness, what do we mean by that? Business readiness is literally just is the business ready itself? And so looking at that, you a lot of times a potential buyer will come in saying, okay, how well can I have certainty into what I'm buying? And so business readiness has to do with, do you have a clearly defined org chart within the practice or your business? Do you have a good, strong management team? Do you have good standard operating procedures? Do you have a good sales team? Do you have efficiencies within your practice? I keep saying practice, but in your company, all these things kind of determine and say, is the business itself as its own entity ready for the owner to exit? The other thing is, and this is a big one, but is the owner ready to exit and start that process of exiting? That's a big one. I think everybody would say that they would want to exit in a way um, that they would like, obviously. But owner readiness is the owner's got to be ready to be willing to say, okay, what is this process look like? What do I need to do? And am I willing to do this? That's a big part of that owner readiness is realizing, okay, there is going to be an exit and it's not going to be done tomorrow. So, am I ready to go through this process that helps me and the business prepare for a sell? And the owner has to have that mindset of wanting to be ready um, to be a part of a successful exit. If not, the owner's going to be reluctant. Um, and that's going to come through with the management team, the org chart. I mean, you're going to see that kind of cascade, that mentality cascade, and you've got to be into it to be into it. And of course, it's just market timing. So, is the market ready for the business? Um, and that's really relevant today because as of the last day of the quarter for 2025, obviously we're seeing the biggest economic news are these tariffs going on in trade wars. And so you're seeing how that's kind of being disrupting to certain industries, which could make it a little bit more difficult for certain businesses in those industries to really have a successful exit. The more certainty you have, the more the market's ready for an exit. The more uncertainty you have, just the more difficult it's going to be. Because at the end of the day, it just comes down to certainty and that a potential buyer is knowing what they're buying as far as either assets or future revenues. So, one, I think to help with this, and this is where wealth advisors such as Sam and myself really uh, start these conversation is identifying the owner's goals. If we had the crystal ball, the perfect crystal ball, and we could ask an owner, okay, if this were to happen, this were to be successful, what does life look like after that? And so we're kind of starting with the end in mind and reverse engineering this. And I use the analogy is kind of like trying to put a puzzle together, but the first thing you do before you start putting pieces together is you got to know what the picture is on the front of the box. It's going to be really hard to start putting these puzzle pieces together if we do not have a good picture of what's on the front of the box. So identifying the goals, time frame, timeline that you'd like to exit. What is the exit type, which we'll talk about here in a minute, the lifestyle needs. We need to clearly articulate what that looks like. So I think it'll help all the advisors on behalf of the owner really say, okay, what are we trying to do here? Because at the end of the day, it's really about identifying the goals to be able to help you in the process. Building business value. So one of the things that we do is we always want to create a baseline valuation of where the business valuation is today. So that can help us because it gives a very honest look on if the owner hasn't done any valuations, giving them a starting point. Okay. And maybe they have in the past, it allows them to update that valuation to have a very honest, transparent view of, okay, if we were to look at this today, what would that value look like? Um, and we have to have that as I call like a baseline because that'll help us either one improve the value and know where to focus our time and energy on, or two, maybe the owner doesn't want to do that and is more accepting of, okay, either I don't have the time, the energy to put into this, and so I'm willing to accept, lower value based on where I stand today, and I'm okay with that. So from there, to be able to build business value, now you're looking at the business through a potential buyer's viewpoint. So a potential buyer is going to look and try to poke holes to some degree. They're going to look at what isn't working, what's not efficient. They're going to look at those things of why should I pay this value, what you're asking, because I'm seeing this, this, and this here. A lot of it might be operational improvements. It just depends, but usually this helps you gain understanding of where the business is. So it helps you focus on some of these blind spots or parts of the business that might have been neglected. We want to maximize financial readiness. Obviously, there's tax strategies involved here. A big one is estate planning, making sure the owner knows the options for all the tax strategies. How do we want to coordinate the sale? Is it going to be counted as ordinary income? Is it going to be a capital gain? Is it going to be some kind of promissory note? All those have different taxable consequences. So obviously having a good CPA and a good relationship with a CPA who deals with business valuation is really crucial in that process. And then of course, preparing for the transition. And so for us, it'd be helpful to know obviously what kind of transition does the owner want. Does the owner want something that's internal, meaning selling to family members or key employees or maybe the management team, or do they want an external sale? That would be maybe to a competitor. That could be to a private equity firm. That could be just to a strategic buyer, whatever it may be. There's We'll talk about that more in depth here, but it's good to understand exactly, there's different ways you can do this. And so I think the owner just has to be educated on the pros and cons of each before deciding. But once you have that preparation and once that decision is made, then it's really a matter of just executing the plan. And so obviously there's things that the advisors need to understand on behalf of the owner to know, okay, how can we plan for this? And then after that, it's just executing the plan. All right. So we talked a little bit about the exit options, but now we're just going to go a little bit further in detail on that. So when I talked about internal transitions, this could be selling to a family member, passing it down. It could be selling it to the employees or partners through the way of ESOPs and MBOs. And so, understanding that um, and what those options and the pros and cons are really helpful for an owner. So for instance, if you were looking at internal transition, really that's something where the owner really cares about culture. Hey, we treated our employees this way. We treated our customers this way. I want to see that continue. We built this business on servitude, making sure we serve each other and serve our customers really, really well. And so what that does is it makes the business feel the same for the employees and customers. And so keeping that culture would be really important to an owner. And so they would typically look at more of an internal transition than selling, to an outside third party. With internal transitions, you can control the process, so you can take things a little slower, knowing, hey, we already have a buyer for this. Now let's be very thoughtful. Let's be a little bit slower paced about this. Let's make sure we're doing things right. A lot of owners don't feel the heat as far as, oh, I got to find people that are willing to buy my business, because they really already have that through the uh, the employees of the company. Um, Legacy preservation. I mean, this is important for some people that want to keep their last name on the building, right? So they want to keep their last name, and they would rather do that because if they sell it to an outside party or private equity, um, the buyer, that's not nearly as important if they don't have that relationship with the customers and the employees, right? So they're going to say, well, that's served us up to here really well, but we want to make some changes to be able to take it a step further. A lot of owners say, well, that doesn't really matter to me so much. I just really want to be able to say, hey, I want this to be and feel like the same company, whether I'm here or not. And so internal transitions um, can be a way for them to have that goal and satisfy that goal as well. The risk of that, of course, is, um, there is there's a phase out with this. So the seller doesn't get paid. There's not a check that's stroked to them day one. It has to be over time. And so that could be a little bit of risk on their end to say, if they really need the money, or if there's a certain lifestyle that they're trying to maintain, the money might be a little bit more important. Right. And so when you think about an internal transition, um, you don't have that. And so you could be giving up a little bit more, either money or of the flexibility, because now you're being paid out over a long period of time, right? And so that's a risk to the company. It's kind of like a pension plan for employees. The fear always has always been for them that, hey, if I don't, this money and this check is great, but what if happens in 5 and 10 years if the company no longer exists? Same way with that internal transition, that is the risk from that end. Whereas if you were go to an external party, a private equity firm or a competitor, then they're more likely to stroke you a check for that amount, where you get paid and where you say, okay, I want the risk off the table. Whatever they do it with it from here is on their end. I got my money. That's what matters to me. Then you would seriously consider an external sale. The valuation is typically higher because now there's competition. You could have multiple potential buyers that are competing for your business, and so it does create that level of competition where you could potentially have a higher valuation point. Um, it's a cleaner break for owners. It's once it's done, it's done. I go this way, buyer goes that way, the company goes that way, and it's just kind of a clean break. But with that, the cons of that are employees could get spooked a little bit. All of a sudden, there's a new sheriff in town, and they may want to do things differently. And so, a lot of owners that want to take care of the employees, or that's important to them, they would, might consider that an option that they don't want to pursue because of that. So, the the external transition is a little bit cleaner, usually a little bit higher valuation, but at the same time, there's no control after the sale. Um, or kind of a hybrid, I would say, would be some kind of recapitalization where, and I see this a lot in certain industries where you could say, okay, um, I want to, or the potential, the owner may want to still continue working in the business, or the potential buyer may want to have the owner continue to work in the business for a certain period of time and almost kind of do like a phase out where they could recapitalize where the new owner says, okay, we'll stroke you a check for this much today, and then but you've got to be here for a certain amount of time, but you will be able to have the ability to participate in the growth. So the buyer and the seller win at the same time. So they stroke a check, hey, owner, here you go. We're serious about this. We want to buy majority. We now have control of it, but we know that you're an important piece of this. So therefore, we're going to head and buy you out, and then we can reevaluate what the what the business is worth at certain checkpoints. So if it's a longer period that you're on, maybe it's 1 to 3 years, they may say, hey, every year we're going to reevaluate. And, we first bought 50% of your business right away. And then, you know, the following 3 or 2 years, you get a 25% buyout at the growth at that point. So it's usually kind of a hybrid method where the risk is kind of shared on both sides. You're not all in, you're not all out. But it's really a way, I think, for a lot of owners that aren't ready just to kind of get out of the business, a way for them to kind of feel like, hey, I can be a part of this, I can participate in the growth of this, but all the heavy decisions, are not on me anymore. And so I think just to be able to have a little bit of education around that and knowing the pros and cons of each is really important, just so owners are educated into knowing, hey, what options are there? And I think that's really, really important for a lot of owners to understand and to know, simply because if not, they don't want to regret making one decision where they didn't know they had another option. All right. So the key to maximizing business value before your exit. All right, so one of the things a lot of buyers will look at are obviously going to be financials, right? So they're going to want to see the key drivers such as recurring revenue, customer diversification, and strong management teams. So typically, and let me back up here and I'll kind of explain, there's three different approaches to valuing a business. One is the asset approach, right? You look at all the assets a person has and says, or a business has, and then you say, okay, I'm going to give you X amount of dollars because I think this is how much the assets are worth. I'll give you that. And it's really just look at valuing the tangible assets of the business and buying those assets. The other way is just doing an income approach where you're basically looking at future income streams and discounting it to a certain rate over time and saying, hey, we're basically buying your future income streams. So there's a quick calculation you can do for that. Um, and that's the income approach. Or the third approach is the market approach, which I always compare, to like buying a house. So when you go to we'll say sell a house, what does the buyer look at? They look at comps. They look at other houses that have similar square footage, similar yards, anything that is kind of apples to apple comparison for them to get an idea of, okay, you're selling a 3,000 square foot house here. Well, that's great because there's another house that sold very, very similar to that with 3,000 square feet, and that sold at X amount of price. So now we're going to take that comp and come back and say, well, we think it's less than that because you have outdated appliances. All the appliances need to be the microwave or the oven. Um, it could be the HVAC or the roof needs to be updated. And so we're going to justify paying less because of these things. Well, in a business, they want to look at, okay, what kind of recurring or revenue do you have? So something some business like a toy manufacturer, they're going to want recurring revenue. So they constantly have to be in front of their customers, reminding them of their product because they purchase a product, and there's no tethering to that company to purchase another product again unless their marketing team is in front of their customers consistently telling them, hey, this is another product of ours you'll want. So you compare that to, I always use this one as kind of like a CPA practice, right? So we know that if you earn income in any way, that is illegal not to do your taxes. So CPA practice says, okay, I'm not sure if I want to have the same exact customers each and every year. And I know there's always going to be this come and go with certain customers, but I know that people are going to have to reach out to a certain degree because there is an automatic need for that because it's illegal not to do your taxes if you have income. So in that regard, there's going to be a little bit more retention or recurring revenue because of that. And so it creates a stickiness factor for a potential buyer to say, I like recurring revenue. It's much more certain, it's much more predictable, and I'm willing to pay a higher multiple because of that. Another thing is also customer diversification. And what that means is basically saying, hey, where is a lot of your sales coming from? There's a big difference between having three customers that are providing high sales to you compared to having 30 customers that are all equal in the amount of product they buy from you. So if you have three customers, if you lost one of them, that's going to be somewhat damaging to your sales and revenue. But if you have 30 and one leaves, it's not going to be nearly as devastating. So, what do you think buyers really want? They want that diversification, knowing that when they purchase something, they have more certainty and predictability on the customers, serving those customers, and hopefully having those customers continuously come back to your business. And then, of course, having strong management teams. So, this is really important. Obviously, the last thing you want is you want to have a strong management team, and all of a sudden, the buyer comes in, purchases it, and it just falls apart. So the potential buyer wants to know, hey, what does that management team look like? How loyal are they? And are they going to stick around, or what benefits did they have after the sale occurs to be able to stay intact? Because obviously, a strong management team is really the core of the human capital side of the business. So if you have a good management team and all of a sudden one person or two people or three people leave, that's a huge risk. So those are ways to look at the real value drivers um, that really justify a certain valuation. Uh, Second thing is reducing risks that deter buyers. So let's talk about dependency on the owner. We see this one a lot. And if the goal with this is to really have the owner sidestep from the business and have the revenue and the earnings continue. That's what a potential buyer wants. So if the culture, if the smaller decisions are all dependent 100% on the owner, that's a risk, and that's going to reduce your multiple for your practice or your business. And so the buyer wants to know at some point if the owner steps away, is this thing going to fall apart? If yes, it is to some degree, then that multiple is going to be reduced because potential buyer can say, well, now I'm going to have to put in a lot of effort, a lot of time and money into this um, to keep this thing going. And so if that's the case, the multiple is going to be reduced because of that. And then, of course, legal compliance issues. Obviously, you want to be compliant with your industry, with your business. You don't want to get into legal trouble. That's going to be a red flag. And it's almost kind of known. You'd think that'd be known of like, yes, this is a given. But again, that's going to be a risk to the business. And of course, time in the market for maximum value. So that's very industry specific. That's going to be factor on a lot of different factors going on in the economy. And you'll want to make sure as much as you can. You can't really control these things, but they are very much a consideration as far as trying to maximize that value. So, preparing yourself personally and financially. So, one of the things that Sam and I do with prospective clients and owners trying to transition is really getting understanding of how much do they need to exit their business. And so this is really important because it kind of sets the tone for the rest of the process. Um, you want to have an idea of what you're willing to settle for and what you're not willing to settle for. And so by doing that, what Sam and I do is we say, okay, what is going back to your goals? What is your goal? What is your lifestyle that you're trying to maintain? What's important to you? Where do you want to spend your time? Where do you want to spend your money? Because once we can do that, now we have an idea of, okay, now we can do our part and do all these what if scenarios. So if the business is valued at X amount of dollars, great. If we can get that, we know we're going to maintain our lifestyle after the sale. This is great. We know we're going to achieve our goal. Anything more than that will be more icing on the cake. That'll be great. Anything less than that, now we have to have other conversations of, is there an adjustment in lifestyle? Maybe we do the things that you want to do, but it doesn't cost nearly as much as you want to pay for things. Instead of paying money on lavish life travels, maybe we have to, chop that in half a little bit. We can still go do things, but not necessarily the way we want to do them in the first place. So that way you can come to the negotiation table knowing what is and is not acceptable and what is considered a win. And too many times in our experience, we've seen owners don't have that number. They don't know exactly what they need, and they really start nitpicking at things here and there just to maximize value. And it can make a deal go south because now the potential buyer is, they're nitpicking every little thing, and the buyer just gets emotionally drained and says, you know what, I'll just walk away from the deal. So knowing what kind of financial freedom you're looking for and having those discussions with a wealth advisor is really, really important, because now you know what you're going to the negotiation table with and what's acceptable and what's not, which is really important. We talked about this, but minimizing taxes. I've never talked to anybody that says I want to pay the government more money, more of their fair share. So obviously taxes are something we don't want to, if we don't have to pay or if we can reduce that amount, then that's what we want to do. And so different exit structures will trigger different taxes. And so this is where having a CPA involved in this is really, really important, because they need to be a part of that discussion to say, hey, if this is what we want to do for the exit, here's what the taxes look like. And so they can also be a part of that conversation. And then, of course, estate planning and wealth transfer strategies. Obviously, the estate planning is really, really important. Those are all contingencies. We want to make sure the money's going where it needs to go. Obviously, these are things we're talking about later in life. So things can happen, and we want to make sure the money's directed and going where it is intended to go. All right. So common pitfalls and how to avoid them. These are the things I think that we've seen um, a lot of times, and these are things that we're trying to avoid at all costs, right? So waiting too long to start planning. That can be voluntary or involuntary. And what I mean by that is waiting too long we hear this a lot, but we hear owners say, I'll never retire. I love what I do for a living. I'm making great money. I have good autonomy in my business. I just have the dream job. This is really, I'm coasting. I feel good about it, and everybody's happy. Um, we hear that often. And then at some point, we also hear this as a response, and it's, hey, I'm tired. I don't want to do this anymore. My priorities have shifted and I want to try and do other endeavors, whether it's being on the board of certain companies, whether it's philanthropic and pursuing those opportunities. It could be spending more time with the kids, the grandkids, and so on. Um, but that can be an example of waiting too long, and then a day comes, and it's almost like, you flip the switch, and it's like, okay, I don't want to do this anymore. Um, and then part of these things can be involuntary as well. What I mean by that is basically your health. So some of these decisions could be made for you, unfortunately, where, if something were to happen to your health, if you are hurt, if you have a stroke, a heart attack, or all these different things that can really say, hey, this is going to be a real big disruptor as far as an exit goes. Now you feel rushed into making decisions. Now you're going to have a sense of urgency, which really is difficult to be able to maximize the value because of that of your business. And so some of these some of the reasons why waiting too long is voluntary and involuntary, but we don't want to necessarily rush the process in this. We want to be there very thoughtful, but at the same time, we don't want to stall out either. The second one is overestimating business value. I gave the story in the very beginning with my dad and hearing the third generation family business owner talk about, how much assets they had. My dad basically said, I don't think you're realistically looking at this. And this is the hardest thing for entrepreneurs and owners. And the reality of it is that entrepreneurs typically start something, they run something, they see the blood, sweat, and tears of what it took to create something, to create great employees, great customers. They're solving a problem in the marketplace, and there's something very satisfying with that. I think where the disconnect occurs is when you have typically an external transfer, a third party competitor, especially private equity, they don't value those things. They do not value the blood, sweat, and tears that a person put into this. They value where's the business today and how much potential do I think it has in the future. That's it. So myself, like anyone would, they tend to overestimate the actual business value because of all those intangibles that, again, a potential buyer, they don't see. And a lot of times, unless you're doing an internal transfer, it doesn't factor into what the value they're giving it to. So by going to see somebody early, having a good team around you, focusing on that earlier in this process, it just creates more honesty and transparency to say, hey, if it's not where you think it might be, let's have that conversation sooner so we can get it there. Because ultimately that's what we want to do is we want to get the business value to where the owner says, okay, either I'm okay accepting lesser value by not putting the time and energy into this, or great, I'm glad you told me now. I'm willing to put the time and energy into this. Now let's get the business value to where we think it should be. And then, of course, ignoring personal and family goals. That's kind of what I talked about earlier is not knowing, hey, how much is enough? How much do you need? How much do you want? And if you neglect to understand what that is, then that can that can be a part of that regret that we talked about in the beginning, which was, 75% of owners regret selling a year after they sold. And so ignoring those personal factors, the family goals, what's important to you, we can't ignore those things. We've really got to talk about that, get that conversation out on the table. And that's what, we do and what we try to help with as well. And then, of course, not having a contingency plan. So this is, we talk about buy sell agreements, we talk about estate planning. The last thing we want to do is have a major disruption with either health or an owner passing away early during this process. So we've got to make sure we have certain life insurances in place. We've got to make sure we have contingency plans. We've got to be thoughtful enough to have that conversation as well, because reality is something could happen, and you don't want to put you or your family at risk of you built something, you did a great job in building it, and now we have to do kind of a quick sale just because something happened that disrupted the whole process. So you want to have contingency plans along the way. All right, so here's the Q&A session. Um, I'm not sure if we have chat on this or not, but Sam, I know you had some questions that people wrote in on. Would you mind sharing those?
Yeah. So I've got a couple of questions to kick it off. Um, you mentioned a little bit about some common pitfalls, but what is the biggest mistake you see business owners having, either coming into this process or getting into this process, just getting their toes wet in the waters?
I think the biggest pitfall is probably being fearful of starting that conversation, being fearful of recognizing and starting the conversation of I need to plan for this. It's very hard. It's very emotional, but it's a needed conversation. And so a lot of owners think that once I have this conversation or once I start this, it's the beginning of the end. And that's not always the case. We don't want to say, hey, this is the beginning of the end. It's no, it's the beginning of trying to be successful at possible at this and keeping your business happy, your employees, your customers, and your family happy at the same time. Um, and I think that first step is typically the hardest step for a lot of owners.
That makes sense. I know we've got one client, he's going into his fourth year, I believe, of getting his business valuated. Keeps doing it every year just to always keep everything in line in preparation for something potentially happening, a buyer potentially coming in, not necessarily willing to sell tomorrow, but just having all of his ducks in a row, keeping us in the conversation, keeping his attorney in the conversation. And that leads me to you talked about, what what people should you be getting involved to create this team for yourself, as a business owner, to really put yourself in a good direction going forward. Put your best foot forward.
Yeah. Yeah, that's great. It does take a team. I'll say that. It'll take a team. So obviously you would need your wealth advisor, personal financial planner involved. You would need a good CPA or accountant. They're going to be very useful and helpful. Also having a good estate planning attorney involved as well. Um, and then having some kind of either business valuation specialist or like broker or someone that can help value the business and um, really give you in-depth look of what that looks like. So I would say those four people are really important to have. And it's going to take all four people to really make sure you cover the blind spots.
I guess that leads into, I know, you know, people may be thinking there may be an upfront cost to, setting everything up the right way. But do you think that's panned out well for people in the past, or, not preparing enough is better?
Yeah, I mean, there's always a little bit of sticker shock when you start engaging some of these folks on your team, and there's going to be costs. There's typically costs for valuations, and um, yes, I think the money is well spent, and there is going to be have to be some time and money spent on this. But to your point, yes, the goal is to be able to put a little bit of money into the business to be able to get it so you're maximizing that multiple. So just like you would sell a house, you want to make sure, hey, the HVAC is a little old. I may have to put some money into this,
Mhm.
or hey, some of these appliances need to be upgraded. But the goal would be that you would end up with a much higher multiple where you look back and say, yes, this was absolutely worth it because it magnified my multiple to some degree.
Yeah, definitely getting that outside opinion of a true valuation, an outsider's look on your business. definitely probably worth it. And then I
Yeah.
guess to tie it all in, what would you say is probably the best first step?
Yeah, I think the first step would be having the conversation with your wealth advisor. I really do think it starts with the end in mind, which is how much do I need? What is this lifestyle that I want to maintain? And having that initial conversation. And that's what I think we've done. And then what happens is you'll start to see other players then get involved at different times. But
Mm.
like I said earlier, I think the first conversation is always the hardest, and that's really the next step.
How does this affect my family at the end of the day?
Absolutely. So,
Awesome.
all right. Well, I know we're running out of time here. We got about 4 minutes left. Hey, just want to thank y'all, everyone. Thank you all for being here. Thank you for spending the time with us. We do appreciate that. And thank you for our sponsors, Franklin Templeton. They're always great and they're very gracious with this and have allowed this. Um, thank you, Sam. So if you want, one of the things we offer at Lighthouse Wealth Group is just a free 30-minute exit planning consultation. Um, there's no obligation, there's no soliciting. It's just hearing you out. What are you looking for? If there's an opportunity to help, we can. If not, we can just steer you in the right direction. And we offer also a business exiting checklist worksheet as well. So please feel free to call us, email me for any of those things. Be glad to help out. And really, the goal here is just to give you a simple education and really help you maximize what you worked so hard for. And that's really what we want to see. And I think at the end of the day, when we see these successes, nothing is more enjoyable to be able to share that process, with these clients. So awesome. All right. Well, thank you all. And feel free to reach out if there's anything we can help with. Y'all take care.
And you have a great day. Bye.